Well, gold is continuing to rally to an all-time high, and now silver is joining the party. It has gone parabolic. Does that mean the rally is nearly done? We'll tell you today. And also, the holy grail of economic data. We got a great report this last quarter, and it has a great clue about the spending on AI and whether that's been worth it for companies. Let's dive into it. Now, before we get into the market update, just a reminder to like and subscribe. 2026 is going to be full of action, and you don't want to miss what we have to say. All right, we're going to go into silver and gold in just a minute. Don't you wait. But we're going to start off with a category that is viewed as the holy grail of economic data, and that is productivity growth. This is basically measuring on an annual basis for workers, for every hour of work, how much are they producing? And this chart goes back to 2010. You can see it has gone up and down during that period. The average has been just about 1.5%. Notice in the last year, this has skyrocketed up to 4.9%, which if you take away the COVID year where all the data went haywire, there has only been one reading in the last 15 years that was higher than 4.9%. Now, let's break this down a little bit. And so I have a couple of different categories up here. You can see productivity in blue at 4.9, then green, because that signifies growth. This is output growth, 5.4%. Very, very strong. So if you're a company and you're getting that kind of output growth, and on the next category in orange, hours worked only went up by 0.5%. So you're not having to pay very much more for a lot more output. That leads to, on the far right, red signifies a decline, and that is unit labor cost. So for every unit of labor, the cost you're paying drops for better output. Listen, this is truly the holy grail. This is big news right now because this kind of data is inflation killer. The Fed has to be very happy to see this. Companies have to be very happy to see this because now they don't have to raise prices to account for higher wages because they're getting a lot more productivity. So we were very happy to see this. And here's the AI takeaway. The question's been asked for a while. Hey, there's a lot of spending on AI. Is it going to lead to positive outcomes for companies? Well, this is an early clue that yes, it is going to pay off in a big way for companies. Well, as you know, gold has been doing very well over the last year or two. There are a couple reasons for that. You have had central banks around the globe led by China, also Russia, India, Japan, the EU, consistently buying gold for their reserves. That's one piece of it. There also has been a trade. We know there's been a lot of government spending. This is something we're going to be covering within the next month here in the US, and spending is out of control. There's a lot of debt, and so people have been saying, hey, in case the dollar really continues to decline, we feel more comfortable in gold. Of late, though, it has started to go up at a faster clip, but that's nothing compared to what silver has done recently. In the last few weeks, it has gone parabolic. That means straight up. So I have a chart that looks at the move higher, both in gold and silver. And this, importantly, is adjusted for inflation. That is a key part of this chart. Take a look at gold. This goes back to the early 1900s. And what really stands out here is this went straight up itself in 1980. Then we had a smaller version of that in 2011. And then we've had this move higher over the last 3-4 months. Silver, let's throw silver up there. And 1980, silver went really straight up. The silver move at that time, there was some manipulation that took place that led to the exaggerated rally during that period. In 2011, silver had another move higher. Didn't get as high as it did in 1980, but still a parabolic move then. And then you can see over the last couple weeks, this truly has gone parabolic. Everywhere you turn, there's talk about silver. We've had some clients calling in asking, hey, what do we make about this move? And this is part of what we do for our clients, is help them when they hear headlines about various topics. We help them talk through and come up with a game plan and let them know how we're managing our portfolios. We do that after we've put a financial plan in place, and that's something that we can do for you if you reach out to us in the future. But coming back to this chart, it's important to highlight that in 1980 and in 2011, after those moves went parabolic, that signified the end of the rally. Both in these occasions, there were precipitous declines. In the case of after 1980, the decline lasted for 19 years, and you had declines of between 70 and 90% for gold and silver. In 2011, the decline lasted for 4 years, and you had a decline between 45 and nearly 70% for gold and silver. So, to answer the question I posed at the end, hey, now that it's gone parabolic, is this the end? The answer is we don't know for sure what's going to happen. But we can say this, if you have not been invested in gold and silver and you're just now hearing about this and deciding, should I put a lot of money in? We would say to be very, very careful. There should be warning signs all around here because the downside is getting to be very, very significant if history is any guide. Next up, we are going to talk about the health of the consumer. The consumer is very key to the economy here in the U.S. And we're going to start off by looking at the Red Book Index. This measures retail sales growth. It's something that we like to show because we get this data on a weekly basis. So it's near real-time look at consumer spending. And we're filming this on January 26th. This is for last week, and growth was 7.1%. We got a couple of really high numbers, as you can see there, in late November and December. But this is the highest number, if you take away that kind of holiday period, this is the highest number since last May. This is what we want to see for consumer spending when they are out spending 7% year over year growth. That is going to be good news for a lot of the retail names when they have their earnings for the first quarter. Now, next up, we want to talk, because this impacts the consumer in a big way, about refunds. The big beautiful bill lowered tax rates last year, and so refunds, Morgan Stanley estimates, are going to be 20% higher than they were last year. The average refund size, you can see from 2010 through 2024, somewhere between $2,500 and $3,000 for most of that period. And then you can see it's expected to have a big increase next. Now, if you look at the next chart, it will illustrate that most tax refunds are paid out between February and April. And of course, that makes sense. So here's the point of tying those together, is that consumers are expected to get a lot higher tax refunds over the next 3 months. History tells us that most of the times those refunds get spent. So it'll be very interesting to watch retail sales when we get into those months. Now, the other factor that comes into play as far as consumer spending is, do consumers have jobs? And on that note, we like to look at jobless claims, initial claims for unemployment insurance. When someone gets laid off, if they can't immediately go find a job, they go file for unemployment insurance. That number just declined to 200,000, and you can see just a few weeks prior, it hit 192,000. That was the lowest number on a weekly number in the last 3 years. 200,000 is also very, very low. So this is telling us again that right now, companies, there just aren't many layoffs taking place. And so when you add all these charts up, it would tell us that the consumer should be in a really good spot as we go through 2026. Now it's time for rapid fire. And this is where we go over a couple other charts that we think you need to know about. And we're starting out looking at forward earning expectations. For 2026, we're talking about here. One of the big keys in 2025 was that earnings expectations continued rising throughout the year. Companies then really delivered all 4 earnings seasons, much higher profits than had been forecast, and that really turbocharged the stock market. Well, in the last 2 months, this is continuing. In fact, if you look, and this is looking at 2026 profit growth, you can see that at the end of November, profits for 26 were projected to be $303 in the S&P 500. In just the last 2 months, that has risen to $307. So this is going to be something we pay close watching to as we go through this year, because it's a high bar to clear after last year superstar results. So in the last 2 months, it's continued to going up. We like to see that. Next chart. We're talking about mega cap tech. Listen, tech stocks hit their peak in late October. So from late October to late January, a lot of the other parts of the market have done a lot better than tech stocks have. And so some people have said, hey, is tech's big run over? We don't believe it is. One key stat we wanted to show you here takes a look at basically 8 to 10 of the biggest tech names. That's who we're talking about here. And this is looking at their valuation. PEG ratio, their valuation divided by their growth rate. All you need to know, we're not going to get in the weeds here. You've made it this long. We are not going to put you to sleep on the last slide. But know this, that when this number is high, tech companies are trading at very high valuations. If it's low, they look attractive. And you can see over the last, say, 10, 12 years, we're now down very close to some of the lowest levels. By the way, at the end of 2022 was the lowest point. That was a golden buying opportunity for tech stocks. We took advantage just about 2 months later after that period. So we think if you're somebody and you haven't had much tech exposure and you're interested in tech, this chart would show you that now is a really good entry point. All right, last chart we do have here, and this we're going to have a little fun because, again, you've made it this long. This takes a look at 10 of the food chains out there and what there has happened with their market share between 2019 and the end of 2024. So starting out, Chipotle has been the biggest gainer. They have gained 8%. Texas Roadhouse gained 7%. Olive Garden 4.5%. Domino's 4%, and First Watch 4%. Then on the negative side, Dave & Buster's down 3%, Pizza Hut down 3.5%, Taco Bell down 4%, Outback down 5.1%, and close your eyes, KFC fans, but the chicken chain down 5.6%. So listen, this is just kind of fun to take a look and see what chains are doing really well, which chains have been struggling over the last few years. We wanted to close it out with this one for you. Okay, so the key takeaway today, the holy grail of economic data, U.S. productivity with some of its highest numbers in 15 years. Very good news for the Fed, very good news for companies. On gold and silver, we said, look, both of these have gone parabolic, which history says you need to be very careful if you're going to put more money in now. And listen, if you don't know whether you should invest in gold or silver or stocks in general, and you don't have anybody to talk it over with, give us a call. That's what we do for our clients. You can go to our website, centeracapital.com, go to the contact page, and we can have a conversation. Well, thanks for watching and take care.